Legal disclaimer. The content presented in this video series, including all strategies, examples, and financial discussions, is strictly for educational and entertainment purposes only. It does not constitute professional financial, investment, tax, or legal advice. The foreign exchange Forex market carries a high level of risk and may not be suitable for all investors. Leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Past performance of any trading system or methodology is not necessarily indicative of future results. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. We are not responsible for any financial losses or damages incurred from the use of this information. Proceed with caution and conduct your own due diligence. 90% of retail traders lose 90% of their capital within their first 90 days of trading. That is not just a frightening statistic. It is the industry standard known as the 90-90-90 rule. If you walk into this market thinking it is a digital ATM where you press a button and money falls out, you are not just going to lose. You are going to be slaughtered by the institutional algorithms that are designed specifically to exploit your psychological weaknesses. The market is not your friend. It does not care about your rent payment, your debt, or your dreams of a luxury lifestyle. It is a ruthlessly efficient mechanism for transferring wealth from the impatient to the patient, from the uninformed to the educated. Most people click off videos like this the moment they hear the hard truth, because they are looking for a magic indicator or a secret signal. If that is you, please leave now. You are the liquidity that the professionals are waiting to absorb. But if you are part of the minority willing to treat this not as a gamble, but as a high-performance business discipline requiring mastery, then you have arrived at the only resource you will ever need. Welcome to the definitive deep dive masterclass on Forex trading. This is not a 10-minute summary. This is a complete deconstruction of the global financial markets, designed to take you from absolute zero to a functional, risk-aware, and competent market participant. Over the next 10 parts, we are going to strip away the noise, the marketing gimmicks, and the false promises of the guru industry. We are going to replace them with the cold, hard mechanics of how money actually moves around the world. We are going to build your understanding of price action, economic structure, risk management, and trading psychology from the ground up. By the end of this series, you will not just know how to read a chart. You will understand the narrative behind the candles and possess the tools to identify high-probability setups while protecting your capital like a fortress. To understand why so many fail, we first have to understand the arena we are stepping into. What exactly is Forex? Most beginners define it simply as exchanging currencies. While technically true, that definition is dangerously simplistic. The foreign exchange market is the cardiovascular system of the global economy. It is where the value of entire nations is weighed against one another in real time. When you trade Forex, you are not buying a piece of a company like you do with stocks. You are betting on the economic performance of one country versus another. It is a macroeconomic battleground. Consider the sheer scale of this environment. The New York Stock Exchange, the largest stock market in the world, trades approximately $20 to $30 billion in volume per day. That sounds like a massive amount of money, and it is. However, the Forex market trades an estimated $7.5 trillion per day. Let that number sink in. Trillion. The Forex market is over 200 times larger than the New York Stock Exchange. Why does this matter to you as a beginner? Because volume equals liquidity. In the stock market, if you buy a penny stock, you might get stuck with it because there is no one on the other side willing to buy it back from you. In Forex, because of this $7 trillion ocean of liquidity, you can enter and exit positions in milliseconds. There is always a buyer, and there is always a seller instantly at almost any volume you could possibly trade as a retail individual. However, this liquidity is a double-edged sword. Because the market is so vast, it is dominated by players who are not like you. You need to know who is sitting at the poker table. The top tier consists of central banks, the Federal Reserve, the European Central Bank, the Bank of Japan. They are not trading for profit. They are trading to stabilize their national economies, control inflation, and manage interest rates. Their moves create the massive trends that can last for years. Below them are the major commercial banks, institutions like JP Morgan, Deutsche Bank, Citibank, and UBS. These banks facilitate the majority of that $7 trillion volume. They have proprietary trading desks with billions in capital and the most sophisticated artificial intelligence systems on the planet. Below them are the hedge funds and large investment firms. Then, at the very bottom of the food chain, there is you, the retail trader. You are trading through a broker, looking at a screen, often with delayed data or limited tools compared to the giants above you. When you buy, you are often buying from a professional who is selling. When you sell, a professional is likely buying. This is why the failure rate is so high. Beginners enter this arena with a casino mindset, thinking they can outsmart institutions that have been doing this for 100 years. You cannot beat them at their game by playing their way. You cannot move the market. You are a minnow swimming alongside whales. The goal of this course is to teach you how to be a remora of fish, the small fish that attaches itself to the shark. We do not try to create the waves. We learn to identify the waves created by the institutions and ride them for a profit before getting out safely. This brings us to the most critical concept you must internalize today: the zero-sum game nature of trading. In the long run, for every dollar of profit you take out of the market, someone else must lose $1. Money in the markets is not created, it is transferred. When you see a screenshot of someone making $10,000 in a day, realize that $10,000 was collected from the accounts of traders who were on the wrong side of that trade. This reality should not scare you, but it should sober you. It demands respect. It means that to be in the top 10% of profitable traders, you must do what 90% of people are unwilling to do. Most people treat trading as a hobby. They trade when they are bored, they trade when they are emotional, and they trade money they need for bills. The market punishes these behaviors with absolute certainty. If you treat this like a hobby, it will cost you like a hobby. If you treat it like a business, it has the potential to pay you like a business. But building a business takes time. You would not expect to become a surgeon in 3 weeks. You would not expect to play in the NBA after watching a few YouTube highlights. Yet, people open a brokerage account on Monday and expect to quit their job on Friday. This delusion is the primary cause of financial ruin in this industry. In this masterclass, we are going to dismantle that delusion. We are going to look at the 3 pillars of successful trading: technical analysis, fundamental analysis, and, most importantly, psychology. Technical analysis is the study of charts, identifying patterns and historical price behavior to predict future probability. Fundamental analysis is the study of economic drivers, interest rates, GDP data, employment reports, and geopolitical events that move the currency values. Psychology is the study of yourself, how you handle fear, greed, patience, and discipline. Most courses focus 90% on the charts and ignore the rest. That is a recipe for failure. You can be the best chart reader in the world, but if you cannot control your emotions when real money is on the line, you will lose everything. Conversely, you can have the mindset of a monk, but if you do not understand market structure, you will slowly bleed your account dry. We are going to start at the very beginning. We will define the terminology so you can speak the language of the market. We will explain what a pair is, why currencies trade in pairs, and the hierarchy of the majors, minors, and exotics. We will break down the concept of the pip, the unit of measurement for movement. We will explain leverage and margin in excruciating detail because misuse of leverage is the #1 reason traders blow up their accounts. Leverage allows you to control large positions with small amounts of money, which sounds great, but it also means a small movement against you can wipe out your entire balance. We will teach you how to calculate that risk before you ever press the buy or sell button. Furthermore, we will dive into the different types of analysis. We will look at candlestick anatomy, what those red and green bars actually tell us about the battle between buyers and sellers. We will explore market structure, identifying if the market is trending up, trending down, or ranging sideways. We will discuss support and resistance, the invisible floors and ceilings that price respects time and time again. But we will not just draw lines on a chart. We will explain why those lines exist, linking them back to the institutional orders resting at those levels. This journey requires a commitment to unlearning bad habits and learning a professional process. It is boring. It is repetitive. It is often frustrating. Real trading is not the excitement of a slot machine. It is the calculated execution of a business plan. It involves sitting on your hands for days, waiting for the perfect setup, and then executing without hesitation. It involves taking a loss, accepting it as the cost of doing business, and not trying to revenge trade to get the money back immediately. You are about to embark on one of the most challenging intellectual pursuits of your life. The barrier to entry in Forex is very low. Anyone with an internet connection and $100 can start. But the barrier to success is incredibly high. It is guarded by the need for discipline, resilience, and continuous education. If you are looking for excitement, go to Las Vegas. If you are looking to build a skill set that can potentially provide independence and financial literacy for the rest of your life, then stay right here. We are going to build your foundation brick by brick, ensuring that when you finally do step into the live market, you are not a gambler, but a speculator operating with an edge. Before we can even look at a chart, we have to learn how to speak the language. Imagine trying to fly a Boeing 747 but you do not know what altitude, thrust, or yaw mean. You would crash before you left the runway. In Forex, the terminology is your instrument panel. If you misunderstand it, you will miscalculate your risk, and the market will penalize you financially for that ignorance. We are going to deconstruct the mechanics of a trade, specifically currency pairs, pips, lots, and the double-edged sword known as leverage. Everything in Forex happens in pairs. Unlike the stock market where you might buy a share of Apple and just hold it, in Forex, you are always simultaneously buying one currency and selling another. It is a transactional tug-of-war. Let us look at the king of all pairs, the euro to US dollar. This is the euro against the US dollar. In this notation, the first currency listed, the euro, is called the base currency. The second currency, the US dollar, is the quote currency. Here is the golden rule you must memorize. The action you take refers to the base currency. If you click buy on euro to US dollar, you are buying euros and paying for them with US dollars. You are betting that the euro's economy will outperform the US economy. If the chart goes up, the euro is getting stronger relative to the dollar. If you click sell, you are selling euros to buy US dollars, betting the euro will weaken or the dollar will strengthen. This creates a unique opportunity compared to stocks because you can profit just as easily when an economy is crashing as when it is booming, provided you are on the right side of the trade. Now, how do we measure that movement? In the stock market, we talk in dollars and cents. If a stock moves from $100 to $101, it moved $1. In Forex, we track movement in pips. Pip stands for percentage in point, or price interest point. For most currency pairs, the pip is the fourth decimal place. Let us construct a scenario. The exchange rate of euro to US dollar is 1.1050. This number means it costs $1.10 and half a penny to buy one single euro. If the price moves from 1.1050 to 1.1051, that is a 1 pip move. It sounds microscopic. Why would anyone care about a fraction of a penny? This is where the magic of volume comes in. If you are exchanging $10 at the airport, a 1 pip move is irrelevant. But if you are a commercial bank exchanging $10 billion, a 1 pip move is $1 million difference. As a trader, you are not trading pocket change. You are trading blocks of currency called lots. Understanding lot size is how you determine how much money you make or lose per pip. There are 3 main sizes you need to know: the standard lot, the mini lot, and the micro lot. A standard lot represents 100,000 units of the base currency. If you are trading a standard lot of euro to US dollar, you are controlling 100,000 euros. In this scenario, every single pip movement is worth approximately $10. If the market moves 10 pips in your favor, a move that can happen in 30 seconds, you make $100. If it moves 10 pips against you, you lose $100. A mini lot is 10,000 units. Here, each pip is worth approximately $1. This is where most serious intermediate retail traders operate. A 10 pip move equals a $10 profit or loss. A micro lot is 1,000 units. Each pip is worth 10 cents. This is where every single beginner should start. If you are new and you are trading anything larger than a micro lot, you are gambling. You need to prove you can be profitable when the stakes are 10 cents per pip before you ever attempt to trade at $10 per pip. The chart looks exactly the same. The only difference is the emotional pressure you feel when the numbers turn red. Now we arrive at the most dangerous and misunderstood concept in trading: leverage. This is the mechanism that allows a retail trader with $500 in their account to control positions worth tens of thousands of dollars. Without leverage, Forex trading would be exclusively for the ultra-wealthy. With leverage, it is accessible to everyone, but it is also the reason 90% of traders blow up their accounts. Think of leverage like a mortgage. If you want to buy a house for $500,000, you do not pay cash. You put down a deposit, say $50,000, and the bank lends you the rest. You now control the asset. If the house value goes up by 10%, your asset is now worth $550,000. You made a $50,000 profit on a $50,000 investment. That is a 100% return on your cash, even though the house only moved 10%. That is the power of leverage. In Forex, the broker lends you the capital to open a standard lot. Let us say your broker offers 1:100 leverage. This means for every $1 you have in your account, you can control $100 of currency. To open that standard lot of 100,000 units, you do not need $100,000. You only need $1,000 of your own money as a good faith deposit, which we call margin. Here is the trap. New traders see 1:500 leverage and think, great, I can make millions with $100. They load up a standard lot with a tiny account balance. They are now trading at $10 per pip. If the market moves just 20 pips against them, which is nothing, just regular market noise, they are down $200. If they only had $200 in their account to start with, the broker will instantly close their trade. This is called a margin call, or a stop out. The broker will not let you lose their money. They will liquidate your account to protect themselves the moment your equity falls below a certain threshold. Imagine this real-world disaster scenario. A beginner named John funds his account with $1,000. He feels confident because he watched a few videos. He opens a standard lot, 1.00, on gold or euro to US dollar because he wants to double his account quickly. He is effectively leveraging his entire account. The news comes out, maybe a US inflation report, and the price spikes down by 50 pips in 1 minute. At $10 per pip, a 50 pip drop is a $500 loss. John just lost 50% of his entire trading capital in 60 seconds. He is now emotionally devastated. He tries to make it back by opening another large trade, and the market moves another 50 pips. His account is gone. He is at zero. This happens every single day to thousands of people. The professional trader uses leverage differently. They might have a $50,000 account, but they still only trade small lot sizes. They use leverage not to gamble, but to free up capital for multiple positions while keeping their risk on any single trade to less than 1 or 2% of their account balance. We will cover the math of risk management in a later module, but understand this now. Leverage amplifies gains and losses equally. It does not care about your feelings. You also have to pay to play. This cost is called the spread. When you go to a currency exchange booth at the airport, you see two prices, we buy and we sell. There is always a gap. If you buy a euro and immediately sell it back, you lose money. That gap is the spread, and it is how the broker makes their profit. In your trading terminal, you will see a bid price and an ask price. You always buy at the higher ask price and you sell at the lower bid price. This means the moment you enter a trade, you are instantly in the negative. You have to overcome the spread just to break even. Let us synthesize this into a life cycle of a trade. You analyze the euro to US dollar. The price is 1.0850. You believe the US dollar is weak, so the pair will rise. You decide to buy. You have a $5,000 account. You want to be prudent, so you select a volume of 0.10, 1 mini lot. This means you are risking roughly $1 per pip. You click buy. You are filled at the ask price of 1.0852, paying a 2 pip spread. You are instantly down $2. 2 hours later, the price rallies to 1.0902. The price has moved 50 pips from your entry. Since you are trading a mini lot, $1 per pip, your profit is $50. You click close. The profit is added to your balance. Your account is now $5,050. That is a 1% gain on your account in 2 hours. That is professional trading. It is not doubling your money in a day. It is compounding small logical wins over time. But how did we know the price was going to go from 1.0850 to 1.0902? Why did we buy instead of sell? This is the million-dollar question. To answer it, we have to stop looking at the numbers and start looking at the pictures. We have to enter the visual world of technical analysis. We need to understand the Japanese candlestick, a method of charting developed by rice traders in the 1700s that is still the standard for Wall Street today. Most people look at a chart and see random red and green bars. A professional sees a narrative. They see a battle where the buyers pushed the price up, the sellers pushed it back down, and a victor was declared. In the next part, we are going to learn how to read these candlesticks like a book. We will uncover what a wick tells you about market exhaustion, and how to spot the exact moment a trend is about to reverse. If numbers are the vocabulary of the market, then the Japanese candlestick is the grammar that turns those words into a coherent story. To the untrained eye, a Forex chart looks like a chaotic electrocardiogram of a heart attack victim. To the professional, it is a detailed historical record of human psychology, panic, greed, and consensus. Before we can trade, we must learn to read the raw data of price action. We are not using line charts. Line charts are for amateurs watching the news. We use candlesticks because a line chart only tells you the closing price, whereas a candlestick tells you the journey the price took to get there. And in trading, the journey matters more than the destination. Let us dissect the anatomy of a single candle. Every candlestick tells you 4 specific pieces of information for a specific period of time: the open, the high, the low, and the close. We call this OHLC data. Shutterstock. Imagine we are looking at a 1-hour candle. The body of the candle, the thick, colored block, represents the distance between the open and the close. If the close is higher than the open, the body is typically green or white. We call this a bullish candle. It means that, over the course of that hour, the buyers were stronger than the sellers and successfully pushed the price up. If the close is lower than the open, the body is red or black. This is a bearish candle. The sellers took control and drove the value down. But the most critical information often lies not in the body, but in the thin lines sticking out of the top and bottom. These are called the wicks or shadows. The top of the upper wick represents the highest price reached during that hour. The bottom of the lower wick represents the lowest price reached. Why is this vital? Because a wick represents failure. Think about that for a second. If you see a long upper wick on a green candle, it means that at some point during the hour, buyers pushed the price all the way to the top of that wick. They were euphoric. They were aggressive. But by the time the hour closed, sellers stepped in with massive volume and forced the price back down, erasing those gains. That upper wick is a scar. It is a footprint of buyers who are now trapped in losing positions. It indicates rejection. The market tried to go higher and was slapboxed back down by the bears. This is a potential signal that momentum is shifting. Let us look at a specific scenario to cement this. Imagine you are at a car auction. The bidding starts at $10,000. That is the open. Bidders get excited and the price shoots up to $12,000. That is the high. But suddenly the room goes quiet. People realize $12,000 is too expensive. The mood shifts. The bids drop. The auctioneer finally slams the gavel at $10,500. That is the close. If you drew this as a candlestick, you would see a small green body and a massive upper wick. That wick tells you that $12,000 was rejected by the market. As a trader, if you see price returning to that $12,000 level, you know there is a history of rejection there. You might look for a sell setup. There are 3 specific candlestick personalities you need to recognize immediately. First is the Marubozu or the momentum candle. This is a candle with a large body and very small or non-existent wicks. Shutterstock. If you see a big green Marubozu, it means buyers opened the price, pushed it up all hour, and closed it at the very highs. There was no hesitation, no rejection, just pure aggression. This tells you the trend is strong. You do not stand in front of a freight train. When you see this, you look to join the trend, not fight it. Second is the doji. This looks like a cross or a plus sign. It has almost no body. The open and the close are almost the exact same price, but there may be long wicks on either side. What does this tell us? It tells us there was a fierce battle. Buyers pushed it up, sellers pushed it down, but in the end, nobody won. It represents indecision. The market is taking a breath. A doji often appears right before a trend reverses or explodes in a new direction. It is a warning sign to pay attention. Third, and perhaps most profitable, is the pin bar, often called a hammer or shooting star. Shutterstock. This candle has a small body at one end and a very long wick protruding from the other, at least 2 to 3 times the length of the body. A hammer forms at the bottom of a downtrend. It shows that sellers pushed price down hard, but buyers surged in and pushed it all the way back up to close near the open. It is a visual representation of a U-turn. It suggests the bears are exhausted and the bulls are taking over. However, a single candle in isolation is meaningless. This is where beginners get slaughtered. They see a hammer and instantly buy, only to watch the price continue crashing. Context is king. You must read the candle in relation to where it appears. A hammer is only powerful if it appears at a significant structural level, which we will discuss later. Furthermore, you must understand the fractal nature of candlesticks. This is a concept that blows the minds of new traders. Every candle is made up of smaller candles. A 1-hour candle contains 4 15-minute candles. A daily candle contains 24 one-hour candles. Imagine you are looking at a daily chart, and you see a massive, scary red candle. It looks like the market is crashing. But if you zoom into the one-hour chart, you might see that the last 4 hours of that day were actually green. The daily candle looks bearish, but the immediate momentum on the lower time frame has already shifted to bullish. This is called multi-time frame analysis. Let's walk through a top-down analysis scenario. You open the daily chart. You see a shooting star, a bearish reversal candle with a long upper wick. This tells you that on the macro scale, sellers are rejecting higher prices. You now have a bearish bias. You are only looking to sell. You do not just click sell yet, your risk would be too wide. You zoom in to the one-hour chart. You see the price going sideways, forming a doji indecision. You zoom in further to the 15-minute chart. Now you see a large red Marubozu candle breaking below the doji. That is your trigger. The daily chart gave you the direction down, the 1 hour gave you the pause, and the 15-minute gave you the entry signal. This puts you miles ahead of the retail trader, who is only looking at one chart. While they are panicking over a small pullback on the 5-minute chart, you are calm because you know the daily chart is still in your favor. You are seeing the forest and the trees. Reading price action is learning to feel the pain and the pleasure of other market participants. When a candle closes, it locks in the profit or loss for that period. If a candle closes green, every seller who held through that period is currently losing money. If the next candle breaks the high of that green candle, those sellers are in serious trouble. They will likely close their positions, which involves buying back, fueling the price even higher. We are hunting for these moments of max pain for the opposing side. We want to enter exactly when the other side is forced to exit. But knowing what a candle means is only step one. A beautiful hammer candle floating in the middle of nowhere means nothing. It is like seeing a stop sign in the middle of a cornfield. You can ignore it. But a stop sign at a busy intersection is critical. In trading, those intersections are called market structure. These are the invisible zones where price has historically reversed support and resistance. If you can combine the story of the candlestick with the location of market structure, you have the basis of a high-probability trading strategy. You will no longer be guessing. You will be acting like a sniper waiting for the target to walk into the crosshairs. But how do you find these invisible lines? How do you know if the market is trending up, down, or just making noise? In the next part, we are going to draw the map. We will define the 3 states of market movement and learn how to identify the key levels that institutional algorithms defend with billions of dollars. Imagine you are dropped into the middle of a dense, unfamiliar jungle. You have a compass, that is your candlestick knowledge. You know which way is north. But a compass is useless if you do not have a map to tell you where the cliffs, the rivers, and the safe paths are. In Forex, market structure is that map. Without it, you are just wandering blindly into quicksand. Price action is not random. It is not a chaotic mess of numbers. It is a structured, repetitive narrative driven by the collective decisions of millions of participants. If you zoom out, you will see that the market moves in 3 distinct ways and 3 ways only. It goes up, it goes down, or it goes sideways. Identifying which state the market is in is the single most important decision you will make before taking a trade. If you try to buy in a downtrend, you are swimming upstream against a raging river. You might make a few inches of progress, but eventually the current will drown you. Let us define the uptrend. Most people think an uptrend is just green candles. Wrong. An uptrend is a specific structural sequence of higher highs and higher lows. Think of it like climbing a staircase. You take a massive step up, that is the impulse phase. Then you stop to catch your breath and maybe step back slightly. That is the retracement or correction phase. Then you take another step up higher than the previous one. Here is the case study of failure. Meet Mike. Mike sees the price shooting up. He sees big green candles. He gets excited. He thinks, it's going to the moon. He buys at the very top of the impulse. But the market needs to breathe. As soon as he buys, the price starts to retrace. It drops. Mike panics. He thinks the trend is over. He sells for a loss at the bottom of the retracement. As soon as he sells, the buyers step back in at the higher low, and the price shoots up again to make a higher high. Mike was right about the direction, but he was wrong about the structure. He bought the high instead of waiting for the higher low. In this masterclass, we trade the higher lows. We wait for the price to pull back, looking for a discount in an established trend. We do not chase the bus. We wait at the bus stop. Conversely, a downtrend is a series of lower lows and lower highs. The market drops, impulse, rallies a little bit, retracement, and then drops further. In a downtrend, the lower high is your fortress. As long as price stays below the previous lower high, the bears are in control. We look to sell, go short. When that relief rally runs out of steam, we are selling the rip, not chasing the dip. Then there is the third state, the one that destroys more accounts than anything else. Consolidation or a ranging market. This is when the market is indecisive. It prints equal highs and equal lows, bouncing between a floor and a ceiling like a ping pong ball. Statistics show that markets range about 70% of the time. They only trend 30% of the time. Yet, most beginners try to use trend-following strategies in a ranging market. They get chopped up. They buy the top of the range thinking it is a breakout and it falls. They sell the bottom thinking it is a breakdown and it rallies. If you cannot identify a clear higher high or lower low sequence, you sit on your hands. Cash is a position. Now let us talk about those invisible floors and ceilings. We call them support and resistance. But I want you to delete the idea of lines from your mind. Price is not precise to the micropip. These are zones. They are areas of interest. Support is a price zone where falling price has historically stopped and reversed. Why? Because at that specific level, demand exceeded supply. The buyers stepped in and said, "This is too cheap." Think of it as a floor made of concrete. When you throw a ball down, it hits the floor and bounces. Resistance is the opposite. It is a ceiling. It is a zone where rising price hit a wall and fell. At that level, supply exceeded demand. Sellers said, "This is too expensive," or "This is a great place to take profit." But why do these levels work? Is it magic? No, it is memory. Traders have long memories. Imagine if the price of gold hits $2,000 and then crashes. Everyone who wanted to sell at $2,000 but missed their chance is now staring at the chart, swearing that if it ever gets back to $2,000 they will sell. Simultaneously, everyone who bought at $2,000 and is now losing money is praying for it to get back to $2,000 so they can get out at break-even. So, when price returns to $2,000, you have a massive influx of sell orders from both fresh sellers and trapped buyers. This creates the resistance. However, the most powerful concept in all of technical analysis is role reversal, or the flip. Shutterstock. Explore. Imagine a multi-story building. You are standing on the floor of the second story. That floor is your support. If you take a sledgehammer and smash through that floor, you fall to the first story. Now, if you look up, that same concrete slab that used to be your floor is now your ceiling, resistance. In trading, when a major support level is broken, it tends to become resistance. When a major resistance is broken, it tends to become support. This phenomenon is the foundation of the break and retest strategy. Let's visualize a break and retest scenario. You are watching the euro to US dollar. There is a ceiling at 1.0500. Price has hit it 3 times and fallen. It is strong resistance. Suddenly, a massive green candle smashes through 1.0500. The rookies see this breakout and instantly buy. This is dangerous. Often, the banks will push price up just to grab liquidity, and then slam it back down, a fake out. The professional waits. They watch the price go up, and then wait for it to come back down to test 1.0500. If the price touches 1.0500 from the top and bounces, the ceiling has successfully become the floor. That is your entry signal. You have confirmation that the structure has changed. You are buying the retest, which gives you a much safer stop loss and a higher probability of success. So, how do you draw these zones? You do not clutter your chart with 100 lines. You look for the major swing points. Look at the daily or 4-hour chart. Where did the price make a sharp V-shaped turn? That is a level. Where did the price struggle to pass for days? That is a level. Focus on the most recent data. A support level from 1995 is likely irrelevant today. We care about where the money is flowing now. Here is a pro tip. Switch your chart from candlesticks to line chart. A line chart removes the noise of the wicks and just shows the closing prices. It makes the V and the shapes of the turning points pop out clearly. Draw your zones on the line chart, then switch back to candles to see the wicks. You will often see that the wicks pierce the zone, but the bodies respect it. This confirms you have found a valid structural level. By combining trend structure, higher highs/lower lows, with support and resistance zones, you are building a confluence. You are not just buying because it looks good. You are buying because the market is in an uptrend. Reason 1. Price has retraced to a previous resistance turn support level. reason 2. And perhaps you see a bullish hammer candle forming at that level, reason 3. Now you have a case. You have evidence. But the market is a shapeshifter. Sometimes it does not just trend or range. Sometimes it paints pictures that foretell the future with uncanny accuracy. These are chart patterns. They are the specific footprints left by the battle between bulls and bears right before a massive move. Have you ever heard of a head and shoulders? A double top? A bull flag? These are not just random names. They are geometric representations of mass psychology. A head and shoulders pattern isn't just a doodle. It is a visual story of a trend trying to make a higher high and failing, signaling a catastrophic collapse is imminent. If you can spot these patterns before they complete, you can position yourself to catch the entire next leg of the move. In the next part, we are going to open the pattern playbook. We will identify the most reliable reversal and continuation patterns that professional traders use to predict breakouts before they happen. You are now seeing the market not as a random casino, but as a battlefield where territory is won and lost. We have covered the individual soldiers, the candlesticks, and the terrain, support and resistance. Now we must study the battle formations. These are chart patterns. A chart pattern is simply a recognizable shape that price creates when it is deciding what to do next. It is a visual representation of mass psychology, resolving a conflict. When millions of traders are unsure whether to buy or sell, the price action compresses and forms specific geometric shapes. When the decision is finally made, the price explodes out of that shape. If you can identify the shape while it is forming, you can predict the direction and the magnitude of that explosion with a statistically significant edge. We categorize these patterns into two distinct families: reversal patterns and continuation patterns. You must know the difference, or you will bet on a trend continuing exactly when it is about to die. Let us begin with the king of reversals, the head and shoulders pattern, Shutterstock. This is arguably the most famous pattern in trading, but few understand the narrative behind it. It is not just a doodle. It is a story of trend exhaustion. Imagine an uptrend. The price surges to a peak and pulls back. This forms the left shoulder. The bulls rush back in with strength and push the price to a new higher peak. This is the head. The trend is technically still alive because we have a higher high. The price pulls back again to the same support level. Now comes the critical moment. The bulls try to push the price up a third time. If the trend were strong, they would make another higher high. But they fail. They run out of money and enthusiasm. The price stalls lower than the head, forming the right shoulder. This lower high is the first crack in the armor. Tells you the buyers are weak. The line connecting the two valleys is called the neckline. When the price breaks below that neckline, the trend is officially dead. The trap has sprung. Professional traders wait for this break to sell, targeting a drop equal to the height of the pattern. The inverse of this applies to the bottom of a downtrend, creating the inverse head and shoulders. Shutterstock. Explore. It is the exact same psychology. Sellers try to push lower head, but fail to push lower again, right shoulder, signaling that the buyers have taken control. Next, we have the double top and double bottom. Shutterstock. These are fierce battles at a specific price level. A double top looks like the letter M. The price hits a resistance level, gets rejected, pulls back, and then attacks the resistance one more time. The second attack fails at the exact same level. This indicates that there is a massive limit sell order or an institutional iceberg order at that price that the market cannot chew through. When the market realizes it cannot break the ceiling, the buyers give up, and the price collapses. However, a word of warning. Beginners lose money on double tops because they sell too early. They see the second top forming and click sell immediately. But often, the market will smash through that level on the third try. You must wait for the price to break the neckline, the low point between the two peaks, to confirm the pattern is valid. Patience pays, anticipation kills. Now let us switch gears to continuation patterns. These are my personal favorites because the trend is your friend. It is statistically easier to make money by betting that a train in motion will stay in motion. The most reliable continuation pattern is the flag pattern. Shutterstock. Picture a strong impulse move up, a vertical green pole. This is the flagpole. After this sprint, the market needs to breathe. Early buyers take profit, causing the price to drift down gently in a tight, parallel channel. This is the flag. It looks like a counter-trend move, but notice the volume. Usually, volume drops during the flag formation. This tells you the selling is weak. It is just profit-taking, not a reversal. Eventually, fresh buyers step in, and the price breaks out of the flag, usually replicating the length of the original flagpole. We also have triangles. These are patterns of compression. Imagine a spring being coiled tighter and tighter. Volatility is decreasing. The market is waiting for news or a catalyst. The ascending triangle is a bullish pattern. Shutterstock. You have a flat resistance level at the top. Sellers are defending a specific price. But look at the bottom. You have a rising trend line. The buyers are stepping in earlier and earlier each time. They are aggressive. They are squeezing the sellers against the wall. Eventually, the sellers run out of ammo, and the price explodes upward through the resistance. The descending triangle is the bearish opposite. A flat support floor, but the highs are getting lower and lower. Sellers are becoming more aggressive, pressing price down against the floor until it shatters. The symmetrical triangle is the neutral zone. Lower highs and higher lows converging into a point. This represents a perfect equilibrium between bulls and bears. In this scenario, we do not guess. We treat the triangle like a cage. We put an alert at the top and an alert at the bottom. We let the market decide which way it wants to break, and then we follow the winner. Now let's apply a case study to bring this together. Imagine you are watching the pound sterling to US dollar, British pound. The market has been rallying for 3 days, uptrend. Suddenly, it stops at 1.3000 and drops to 1.2950. It rallies back to 1.3000 and drops again. You spot a double top. Do you sell? No. You wait. The price drops to 1.2950, the neckline, and bounces a little. Then, a strong red candle smashes through 1.2950. Now, do you sell? You could, but the smart money often waits for one more thing, the retest. Remember role reversal from the last section? We wait for the price to come back up to 1.2950, kiss it and get rejected. That kiss confirms that the floor has become the ceiling. That is the highest probability entry in trading. You enter short, placing your stop loss just above the rejection wick. You have aligned market structure, support/resistance, and a chart pattern into a single cohesive trade idea. Be very careful of false breakouts or fakeouts. This is when price breaks a pattern, say the neckline of a head and shoulders, by just a few pips, trapping the breakout traders, and then immediately reverses in the opposite direction. This is a favorite maneuver of institutional algorithms to grab liquidity. To avoid this, apply the rule of close. Never trade a breakout while the candle is still moving. A live candle is a lie. It can look like a massive breakout with 1 minute left in the hour, and then close as a massive rejection wick. You must wait for the candle to close outside the pattern. A closed candle is a confirmed fact. A moving candle is just a rumor. We have now covered the visual aspect of trading. You can read the raw price, but sometimes price action can be deceptive. Sometimes a trend looks strong, but internally it is running on fumes. How can we see inside the candles to measure the actual momentum and strength of the move? This is where we introduce the instrument panel of your trading cockpit. Technical indicators. There are thousands of them and most are useless noise. But there are a select few, the big three, that professional desks rely on to filter their decisions. We are going to strip away the complex math and show you how to use them not as magic signals, but as confirmations of what the price is already telling you. In the next part, we are going to master the moving average, the RSI, and the concept of divergence, a hidden signal that often predicts a market reversal long before the chart pattern even forms. We have spent the last few sessions analyzing the raw footprint of the market, the candlesticks and the patterns they form. But relying solely on naked price action can sometimes feel like driving a car by only looking out the windshield. You can see the road, but you do not know how fast you are going, how hot the engine is running, or how much fuel is left. Technical indicators are the dashboard of your trading cockpit. They do not drive the car, price does that, but they provide critical data about the vehicle's performance that you cannot see with the naked eye. However, before we install these tools, we must address the indicator trap that ensnares almost every beginner. You will see charts online that look like abstract art, covered in 20 different colored lines, clouds, and oscillators. This is analysis paralysis. Professional traders use indicators sparingly. They use them to filter decisions, not to make them. We are going to master the big three that have stood the test of time: moving averages, the relative strength index, RSI, and the moving average convergence divergence, MACD. First, let us look at the trend filter. The moving average, MA. Price action is jagged. It spikes up and down due to noise and temporary volatility. A moving average smooths out that data to show you the true underlying trend. It calculates the average price over a specific number of candles and draws a single flowing line. There are two types you need to know: the simple moving average, SMA, and the exponential moving average, EMA. The SMA treats every candle equally. The EMA gives more weight to the recent candles, making it react faster to current price changes. For trading, we prefer the EMA because in this game speed matters. Imagine the 200 EMA. This is a line calculated on the last 200 periods. On a daily chart, this line is widely considered the institutional line in the sand. Here is a simple rule that keeps fund managers on the right side of history. If the price is above the 200 EMA, the market is in a long-term uptrend. We only look for buy setups. If the price is below the 200 EMA, the market is in a downtrend. We only look for sell setups. By strictly following this rule, you eliminate the disaster of trying to catch a falling knife. You are always trading with the current, not against it. We also use moving averages as dynamic support and resistance. Remember how we drew horizontal zones for support? In a strong trend, price often does not pull back deep enough to hit a horizontal level. Instead, it pulls back to the 20 EMA or the 50 EMA and bounces. Think of the EMA as a moving floor that rises underneath the price, pushing it higher. A classic strategy is to wait for an uptrend, watch price pull back and touch the 50 EMA, and if you see a bullish candlestick pattern like a hammer form on the line, that is your entry. Next, we have the thermometer of the market, the Relative Strength Index or RSI. This is an oscillator, meaning it moves between 0 and 100. It measures the velocity and magnitude of price movements. It answers the question: is the market overextended? Traditionally, the RSI has two key zones. Above 70 is considered overbought, and below 30 is considered oversold. And this is where the rookie loses their money. The rookie sees the RSI hit 70 and thinks, "It's too expensive, I must sell." But in a strong parabolic trend, the RSI can stay above 70 for weeks. Price can double while the RSI is overbought. Selling just because the RSI is high is like standing in front of a speeding train because the speedometer says it is going fast. The professional uses RSI to spot divergence. This is one of the most powerful concepts in technical analysis. Divergence occurs when the price tells one story, but the momentum tells another. It is a crack in the facade. Imagine the price of gold is climbing. It hits $2,000, pulls back, and then rallies to $2,050. That is a higher high. The trend looks healthy, but when you look at the RSI, you see that while price made a higher peak, the RSI made a lower high. This is bearish divergence. It means that although the price is rising, the engine is running out of fuel. The momentum is dying. This is a massive warning sign that a reversal is imminent. It is often the signal to exit a long position or prepare for a short position. Conversely, bullish divergence happens in a downtrend. Price makes a lower low, smashing through support, but the RSI makes a higher low. The sellers are exhausted. The elastic band is stretched to its breaking point and is about to snap back. Finally, we have the MACD, Moving Average Convergence Divergence. This tool combines trend following with momentum. It consists of two lines, the MACD line and the signal line, and a histogram, the bars. The most basic signal is the crossover. When the faster line crosses above the slower line, it is a buy signal. When it crosses below, it is a sell signal. But again, crossovers lag. They happen after the move has started. The true value of the MACD is in the histogram. The bars represent the distance between the two moving averages. When the bars are growing larger, the trend is accelerating. When the bars start shrinking, the trend is fading. If you see the price making new highs, but the MACD histogram bars are getting smaller and smaller, shrinking toward the zero line, that is a visual representation of the buyers losing conviction. Let's build a case study to synthesize all of this. We will call it the triple threat strategy. Imagine you are looking at the euro to US dollar on a 4-hour chart. Step 1, trend check. You see the price is clearly trading above the 200 EMA. You are only interested in buying. Step 2, the pullback. The price dips down. It does not crash. It floats down gently and touches the 50 EMA. It respects that dynamic support. Step 3, the trigger. You look at the RSI. The price has made a slight lower low into the 50 EMA, but the RSI has made a higher low. You have bullish divergence. Step 4, the confirmation. You wait for the MACD lines to cross upward. When all four of these align, trend, dynamic support, divergence, and momentum crossover, you have a high probability setup. You are not guessing. You are executing a plan based on evidence. You place your stop loss below the 50 EMA and target the previous high. However, even with the perfect technical setup, you can still lose. You can have the perfect head and shoulders, the perfect divergence, and the perfect support level, and then, in the blink of an eye, a single red candle can wipe out your position and drop the market 200 pips. Why? Because charts do not move the market. People move the market. And people react to real-world events. A chart cannot see a war breaking out. A moving average cannot predict an unexpected change in interest rates by the Federal Reserve. An RSI cannot read an election result. While technical analysis tells us where to enter, fundamental analysis tells us why the market is moving and where it is likely to go in the long term. Most retail traders ignore fundamentals because they think it is too complicated. They think they need a degree in economics to understand it. This is false. You do not need to be an economist. You just need to know how to read a calendar. There are specific days and times when you strictly do not trade. There are reports released by governments that act as financial tsunamis. If you are holding a trade during these events without knowing, you are gambling with your financial life. We are about to leave the comfortable world of lines and shapes and step into the chaotic, high-stakes world of global macroeconomics. In the next part, we are going to decode the economic calendar. We will explain what NFP, CPI, and FOMC mean, and why these acronyms strike fear into the hearts of unprepared traders. We will teach you how to trade the news, or more importantly, how to survive it. We have all been there. You spend hours analyzing a chart. You find the perfect support level, the RSI is oversold, and you have a beautiful double bottom pattern. You execute the trade with confidence. You are in profit. Then suddenly at 8:30 a.m. New York time, a single vertical candle rips through your stop loss, wipes out your account, and moves 300 pips in the opposite direction in less than a second. You stare at the screen in horror, wondering what went wrong. The chart looked perfect. What went wrong is that you brought a knife to a nuclear war. You were looking at the lines, but you ignored the world. While you were analyzing pixels, the United States Bureau of Labor Statistics released a report that changed the valuation of the entire U.S. economy. This is fundamental analysis. While technical analysis focuses on the when to enter, fundamental analysis dictates the why and the where. It is the study of the economic forces, interest rates, inflation, employment, and politics, that determine the intrinsic value of a currency. If you want to understand why currencies move, you must understand one single, all-powerful concept: interest rates. Everything in Forex revolves around interest rates. Think of it like this: imagine you have $1 million to invest. You can put it in a European bank that pays you 1% interest per year, or you can put it in a US bank that pays you 5% interest per year. Where does the money go? It flows to the US bank. To put money in the US bank, you have to sell euros and buy US dollars. This massive flow of capital from low interest rate economies to high interest rate economies is what creates the multi-year trends we see on the charts. Central banks like the Federal Reserve in the US or the ECB in Europe control these rates. Their job is to balance the economy. If the economy is too hot, high inflation, they raise rates to cool it down. If the economy is struggling, recession, they cut rates to stimulate spending. As a Forex trader, you are essentially a professional central bank watcher. You are trying to predict what the Federal Reserve will do next. To do this, you need the economic calendar. This is your schedule. Every Sunday before the market opens, you must look at the calendar for the week ahead. Events are typically color-coded: yellow for low impact, orange for medium impact, and red for high impact. We only care about the red folders. These are the market movers. There are 3 specific events that you must treat with extreme caution. First is the CPI, or Consumer Price Index. This measures inflation. It tells us how much the price of a basket of goods, milk, gas, rent, used cars, has risen or fallen. Why does this matter? Because if CPI comes in hot, higher than expected, it means inflation is rising. If inflation is rising, the Federal Reserve will be forced to raise interest rates to fight it. Higher interest rates mean a stronger dollar. So a high CPI number typically causes the USD to skyrocket instantly. Conversely, a soft CPI suggests inflation is cooling, which might lead the Fed to cut rates, causing the dollar to drop. Second is the NFP, or non-farm payrolls. This is the Super Bowl of economic data. It is released on the first Friday of every month at 8:30 a.m. Eastern Time. It measures how many jobs the U.S. economy added or lost, excluding farm workers. If the U.S. adds more jobs than expected, the economy is strong, causing the dollar to rally. If the numbers are weak, the dollar sells off. The NFP is famous for its whipsaw effect. The volatility is so extreme that price can spike 50 pips up and 50 pips down in the same minute, triggering stop losses on both sides before picking a direction. Third, and most important, is the FOMC, or the Federal Open Market Committee meeting. This happens 8 times a year. This is when the Federal Reserve actually announces the new interest rate. But the rate decision itself is often less important than the press conference that follows 30 minutes later. During this conference, the chairman of the Federal Reserve speaks. Every single word he says is scrutinized by algorithms. If he sounds hawkish, aggressive about fighting inflation, the market buys dollars. If he sounds dovish, concerned about growth and willing to lower rates, the market sells dollars. Now, how do you trade this? The amateur strategy is to guess. They see the forecast says the data will be good, so they buy 5 minutes before the release. This is essentially gambling on a coin flip. The forecast is often wrong, and even if the data is good, the market might have priced in the result already, leading to a buy the rumor, sell the news event where the price drops despite good news. The professional understands the mechanical risks of trading news. During a major release like NFP, liquidity dries up. The major banks pull their orders because they do not want to get run over. This causes the spread, the difference between the buy and sell price, to widen massively. Normally, the spread on euro to US dollar might be 1 pip. During NFP, it can explode to 20 or 30 pips. This leads to slippage. Imagine you have a stop loss set at 1.0500. The price is at 1.0510. The news breaks and the price crashes. Because there is no liquidity, the price does not tick down smoothly, 1.0509, 1.0508. It gaps. It jumps from 1.0510 straight to 1.0450. Your stop loss at 1.0500 is ignored because that price never existed in the market during the drop. You get filled at 1.0450, losing 50 pips more than you intended. This is how accounts go into negative balance. So what is the strategy? Strategy 1. The straddle. This is for the brave. 10 minutes before the news, you identify the consolidation range. You place a buy stop order above the range and a sell stop order below the range. The idea is that the news will trigger a massive move in one direction, activating one of your orders and carrying you into profit. You cancel the untriggered order immediately. However, the risk here is the whipsaw. The price could spike up, trigger your buy, then immediately crash down, trigger your stop loss, and then continue down. Strategy 2, the reactive approach. This is for the wise. You do absolutely nothing when the news breaks. You sit on your hands. You watch the chaos. You let the amateurs get slaughtered by the volatility. You wait for 15 minutes. Usually by 8:45 a.m. the initial panic is over, and the true market direction is revealed. If the NFP number was incredibly strong, the initial spike might be messy, but after 15 minutes you will see a clean, steady uptrend forming. You enter then with a defined risk, riding the momentum created by the fundamental data. Let's look at a hypothetical case study. It is Wednesday. The US CPI data is due. The forecast is 3.1%. The market is expecting inflation to drop. You mark your charts. 8:30 a.m. hits. The number comes out, 3.5%. Inflation is hotter than expected. Panic hits the bond market. Yields spike. Instantly, the algorithms sell euro to US dollar, buying dollars. The price drops 50 pips in 3 seconds. You do not chase it. You wait. At 8:45 a.m., the price pulls back up to retest a key resistance level, perhaps the price where the drop started. This is the retest. Now that you know the fundamental driver, high inflation equals strong dollar, you use your technical analysis to enter a short position at the resistance. You have fundamental bias backing your technical setup. This is the holy grail of trading. Fundamentals give you the macro direction. If the US economy is booming and Europe is in a recession, you should only be looking for sell setups on euro to US dollar. Even if you see a bullish pattern on the 5-minute chart, you ignore it because it goes against the big picture. You are swimming with the tide of the global economy, not against it. However, knowing the direction is not enough to save you. You can be right about the direction, right about the news, and right about the entry, And you can still lose all your money if you do not understand the mathematics of survival. You can turn a winning strategy into a losing career simply by betting too much on a single trade. Most traders think the secret is predicting the future. It is not. The secret is managing the present. It is about how much you lose when you are wrong compared to how much you make when you are right. We are about to enter the most boring, yet the most critical part of this entire masterclass. It is the only reason I am still here today while my peers from 10 years ago are driving Ubers. In the next part, we are going to perform the mathematics of survival. We will explain position sizing, risk-to-reward ratios, and the psychological fortress you need to build to accept losses without blinking. This is the graveyard of potential. This is where the dreamers die and the professionals are born. You can master every candlestick pattern, memorize every central bank policy, and have the best entry signals in the world. But if you do not master the mathematics of survival, you will eventually go broke. It is a mathematical certainty. The market is an infinite environment of probability. Anything can happen at any time. Because you cannot control the outcome of any single trade, you must control the only thing you can: the amount of money you lose when you are wrong. Welcome to the discipline of risk management. This is not the sexy part of trading. It is not exciting. It is, however, the insurance policy that keeps you in the game long enough to become profitable. Let us begin with the mathematics of ruin. Most beginners ignore this until it is too late. They think, if I lose 50% of my account, I just need to make 50% back to break even. This is mathematically false. If you have a $10,000 account and you lose 50%, you are left with $5,000. To get back to $10,000, you need to make a $5,000 profit on a $5,000 base. That is a 100% return. You have to double your money just to get back to zero. If you lose 90% of your account, you need a 900% return to break even. That is impossible for even the best hedge funds in the world. This is why preserving your capital is infinitely more important than growing it. Rule number 1 is not make money. Rule number 1 is don't lose money. To ensure we never fall into this hole, we apply the 1% rule. This is the industry standard for longevity. You never, under any circumstances, risk more than 1% of your account equity on a single trade idea. If you have a $10,000 account, your maximum risk is $100. If you have a $100 account, your maximum risk is $1. This sounds slow. You are thinking, how will I get rich risking $1? You are missing the point. The goal is survival. If you risk 1%, you would have to lose 100 trades in a row to blow your account. Even a monkey hitting random buttons would not lose 100 times in a row. By risking 1%, you remove the emotional panic from the equation. If you lose the trade, you still have 99% of your ammo left. You are calm. You can think clearly for the next setup. But how do you practically risk exactly 1% when the stop-loss distance changes on every trade? This is where position sizing comes in. This is the variable most amateurs get wrong. They trade the same lot size every time. They say, I always trade 0.10 lots. This is suicidal. Imagine two trades. Trade A is a scalp on the 5-minute chart with a 10-pip stop loss. Trade B is a swing trade on the daily chart with a 100-pip stop loss. If you use a 0.10 lot, where 1 pip equals roughly $1, for both. In trade A, if you hit your stop, you lose $10. In trade B, if you hit your stop, you lose $100. Your risk is fluctuating wildly based on the volatility of the market. This is inconsistent. A professional calculates the lot size after determining the stop loss. The formula is risk amount divided by stop loss distance equals position size. Let's run the numbers. You have a $10,000 account. Your risk limit is 1%, $100. Scenario 1. You find a trade with a 20-pip stop loss. You take $100 divided by 20 pips. That equals $5 per pip. To trade $5 per pip, you open a 0.50 lot. Scenario 2. You find a trade with a 50-pip stop loss. You take $100 divided by 50 pips. That equals $2 per pip. You open a 0.20 lot. In both scenarios, if the trade hits your stop loss, you lose exactly $100. You have standardized your risk. Whether the market moves 10 pips or 100 pips, your financial loss is fixed. This is how you stabilize your equity curve. Now that we have capped the downside, let's talk about the upside. This is the risk-to-reward ratio, RR. This concept destroys the myth that you need a high win rate to be profitable. Most people think they need to be right 90% of the time to make money. The truth is, you can be wrong 60% of the time. You can be a loser more often than a winner, and still make a fortune. How? By ensuring that your winners are always significantly larger than your losers. We target a minimum risk-to-reward ratio of 1 to 3. This means for every dollar we risk, we expect to make $3 in profit. Let's simulate a bad trader scenario. Imagine you take 10 trades. You are not very good, so you lose 6 of them and only win 4. That is a 40% win rate. Most people would quit. But let's look at the math with a 1 to 3 ratio. You risk $100 per trade. You lose 6 trades x $100 equals minus $600 loss. You win 4 trades. Since your reward is 3 times your risk, $300, you make 4x $300 equals plus $1, $200 profit. Total net profit, $1,200 minus $600 equals $600. You failed 60% of the time, yet you grew your account by 6%. This is the magic of asymmetric returns. You do not need to be a prophet, you just need to be a disciplined mathematician. If you take trades with a 1-to-1 ratio, risking $100 to make $100, you must be right more than 50% of the time just to break even. That is too much pressure. The market is too unpredictable for that. Stack the odds in your favor by demanding a higher payout for your risk. However, a ratio is useless if you do not respect the stop loss. The stop loss is not a suggestion. It is an invalidation point. When you place a stop loss, you are saying, if price reaches this level, my analysis was wrong. Many beginners commit the cardinal sin of trading, moving the stop loss. Imagine you buy euro to US dollar. The price starts dropping. It gets close to your stop. You think, it's just a temporary dip. I'll give it a little more room. You move the stop down 10 pips. It drops further. You move it again. You are now bargaining with the market. You have turned a calculated 1% risk into an undefined emotional gamble. Eventually, the market keeps dropping and you panic close for a 10% loss. You just wiped out the profits of your last 10 winning trades in a single moment of weakness. You must accept the loss before you even enter the trade. Treat it like a business expense. If you own a restaurant, you have to buy food. If the food spoils, you throw it away. You don't cry about it. It is the cost of goods sold, COGS. In trading, losing trades are your cost of goods sold. You pay the loss to buy the information that the market is not going in your direction. Here is a case study of 2 traders, aggressive Andy and systematic Sarah. Andy wants to get rich quick. He risks 10% per trade. He wins 3 trades in a row and feels like a god. His account skyrockets. Then he hits a losing streak of 4 trades. Due to the mathematics of ruin, his account is decimated. He is now emotional, trying to revenge trade, and eventually blows the entire account. Sarah risks 1% per trade. She loses 3 trades in a row. She is down 3%. She grabs a coffee, analyzes her mistakes, and waits for the next setup. She hits a 1:3 winner. She is back to break even. She hits another 1:3 winner. She is up 3%. Over the course of a year, Andy is broke, and Sarah has compounded her account by 40%. The tortoise does not just beat the hare. The tortoise owns the racetrack. You now have the technical skills to read the chart. You have the fundamental knowledge to understand the economy. You have the risk management rules to protect your capital. But there is one final enemy. An enemy that lives inside your own head. You can know exactly what to do, but when real money is on the line, when your heart is racing and your palms are sweating, will you actually do it? Will you have the discipline to hold a winning trade when every instinct screams, take the profit now? Will you have the courage to take a loss when your ego screams, I'm right? The distance between a losing trader and a winning trader is 6 inches, the space between your ears. In the next part, we are going to dissect the psychology of winning. We will explore FOMO, revenge trading, and the mental frameworks used by elite hedge fund managers to execute without emotion. You are not fighting the market. You are fighting your own DNA. This is the hardest truth you will ever have to accept. Human beings have evolved over millions of years to survive in the wild. Our brains are wired to seek safety, to hoard resources, to be right, and to avoid pain at all costs. In the savannah, these instincts kept us alive. In the financial markets, these exact same instincts will get you killed. The market is designed to trigger your fight or flight response, flooding your system with cortisol and dopamine, effectively shutting down the logical part of your brain, the prefrontal cortex, and handing the controls over to the amygdala, the emotional center. When you are trading under the influence of emotion, you are literally functionally lower in IQ than when you are calm. You are trading like a caveman staring at a chart. Let's analyze the 4 horsemen of the trading apocalypse: FOMO, greed, fear, and revenge. First, there is FOMO, the fear of missing out. Imagine this scenario. You wake up, open your laptop, and see that gold has just shot up 100 pips in the last 30 minutes. A massive green candle is piercing the top of your screen. You check social media and everyone is celebrating. "Gold to the moon," they scream. You feel a physical knot in your stomach. You feel like you are being left behind. You tell yourself, "If I don't get in now, I'll miss the whole move." You ignore your strategy. You ignore the fact that the price is hitting a major resistance level. You click buy at the very top of the candle. 10 seconds later, the candle closes and the next one opens red. The price starts to plummet. You just provided exit liquidity for the institutional traders who were buying at the bottom. They were waiting for you to feel that FOMO so they could sell their positions to you at a premium. FOMO is the market soliciting your greed. The cure for FOMO is a simple mantra. There is always another train. The market is not going away. If you miss a move, so be it. A missed trade costs you $0. A forced trade can cost you everything. Next, we have revenge trading. This is the most destructive psychological flaw. Imagine you take a valid setup on euro to US dollar. You risk 1%. The market moves against you and hits your stop loss. You lose $100. Physically, you are fine. Financially, you are fine. But your ego is screaming. You feel stupid. You feel like the market stole your money. You think, "I know it's going to go up. I just entered too early." So you immediately re-enter the trade. You do not wait for a setup. You just click buy again. And to make back the $100 you lost quickly, you double your lot size. Now you are risking 2%. The market drops further. You are now down $300. You are furious. You think, "It has to turn around." You add another position. The market crashes. You have now blown 10% of your account in 10 minutes because you could not accept a 1% loss. This is revenge trading. It is the refusal to accept that you were wrong. The market does not know you exist. It is not personal. Trying to get revenge on a chart is like trying to punch the ocean because a wave got you wet. Then comes greed. Greed is not just wanting money. It is wanting money now and refusing to follow the rules when you have it. Greed manifests when you are in a winning trade. You bought at the bottom and you are up $500. Your target was $400. You should have exited. But you watch the green numbers ticking up and you think, "Maybe this is the one that makes me a millionaire. Maybe it will go forever." You cancel your take profit order. You start dreaming of the Ferrari. Suddenly, the market reverses. That $500 profit turns into $300. You think, "I'll close it when it gets back to 500. It drops to 100. You think, "I'll close at break even." It drops to negative 100. You turned a winning trade into a losing trade because you did not pay yourself. You let hope replace logic. Finally, there is fear. This is the paralysis that strikes after a losing streak. Imagine you have lost 5 trades in a row. You are demoralized. Suddenly, the perfect setup appears. It matches every single rule in your strategy. The RSI is diverging, the support holds, the hammer candle forms. But you cannot click the button. You are terrified of losing again. You watch the trade play out perfectly without you. You missed the win that would have erased your losses. Fear makes you hesitate when you should strike. And greed makes you hold when you should fold. So, how do the elite professionals overcome this? Do they remove their emotions? No. You cannot remove emotions. You are human. They manage them using a specific mental framework called thinking in probabilities. This concept was popularized by the late Mark Douglas in his seminal work, Trading in the Zone. Most beginners think in a trade-by-trade perspective. They judge their success on the outcome of the current trade. If it wins, they are happy and feel smart. If it loses, they are sad and feel dumb. This is a roller coaster. The professional thinks in a series of trades. Imagine you have a weighted coin that lands on heads 60% of the time. If you flip it once and it lands on tails, are you angry? Do you think the coin is broken? No. You know that over 100 flips, 60 will be heads and 40 will be tails. You do not care about the individual flip. You care about the mathematical edge over time. You must view your trading strategy the same way. If you have a strategy with a 50% win rate and a 1 to 2 risk-to-reward ratio, you are the casino. You have the edge. Over 20 trades you will make money. When you truly accept this, a losing trade no longer hurts. It is just one of the necessary tails flips in your series of 20. It is simply the cost of doing business. You are not betting on this one trade to win. You are betting that your edge will play out over the next month. To enforce this discipline, you need a trading plan that acts as your law. A trading plan is a physical document that dictates exactly what you will do in every scenario before it happens. It removes the need to make decisions in the heat of the moment. Your plan should say, I only trade euro to US dollar and pound sterling to US dollar. I only trade between 8 a.m. and 11 a.m. New York time. I risk 1% per trade. If I lose 2 trades in a day, I stop trading for 24 hours. That last rule, the daily stop loss, is the ultimate circuit breaker. Just like the stock exchange halts trading if the market crashes too hard, you must halt yourself if you are emotionally compromised. If you lose 2 trades in a row, your objectivity is gone. You are likely tilting. By walking away, you protect your capital from your own psychology. You live to fight another day. Case study: the tale of 2 mindsets. Trader A sees a setup. He feels good about it. He risks 5% because he has a hunch. He wins. He feels invincible. The next day, he risks 10% on a sure thing. He loses. He is devastated and tries to win it back. He is gambling. Trader B sees the same setup. She checks her plan, meets the criteria. She calculates her position size to risk exactly 1%. She places the trade and walks away from the screen. She does not stare at the candles. She knows that once the trade is placed, the outcome is out of her control. Whether it hits the stop loss or the take profit, she accepts it as a data point. She is a business owner executing a process. You need to become Trader B. You need to become a robot in execution and a human in analysis. You must detach your self-worth from your account balance. Your value as a person has nothing to do with whether the euro to US dollar went up or down today. We have now covered the mechanical, the fundamental, the mathematical, and the psychological. You have all the components of the machine. But a pile of car parts is not a car. You need to assemble them and turn the key. You need to know how to actually start. Which broker do you choose? Which platform? How do you backtest? How do you transition from a demo account to real money without choking? In the final part of this masterclass, we are going to build your Go Live blueprint. We will give you a step-by-step roadmap for your first 30 days, showing you exactly how to launch your trading career from zero to your first live trade. This is the moment where the rubber meets the road. You have spent the last 9 sessions downloading the software of a professional trader into your mind. You understand the language of pips, the structure of trends, the impact of economic data, and the armor of risk management. But knowledge without execution is just trivia. You cannot learn to swim by reading a book about hydrodynamics. Eventually, you have to get wet. However, we are not going to throw you into the deep end of the ocean with sharks. We are going to wade in step by step, following a strict military-grade protocol designed to protect your capital while you build your competence. This is your 30-day launch blueprint. Day 1 through Day 3 are dedicated exclusively to infrastructure and security. Before you look at a chart, you must choose a broker. This is the single most dangerous decision a beginner makes. The internet is flooded with unregulated offshore brokers who promise you massive leverage, sometimes 1:500 or 1:1000, and zero spreads. These are often scams or B-book bucket shops. In a B-book model, the broker takes the other side of your trade. If you win, they lose. If you lose, they keep your money. They are incentivized to make you fail. You must choose a regulated broker. If you are in the United States, you are looking for regulation by the CFTC, Commodity Futures Trading Commission, and membership in the NFA, National Futures Association. If you are in the UK, look for the FCA. In Australia, the ASIC. These regulators force brokers to segregate your funds from their operating capital. If a regulated broker goes bankrupt, your money is protected. If an unregulated island broker disappears, your money is gone forever. Do not chase high leverage. High leverage is a trap for the inexperienced. Stick to the regulated standard, usually 130 or 150 for major pairs. Once you have selected a reputable broker, you need to set up your command center. Professional traders split their workflow into 2 platforms. We use TradingView for charting and analysis because it is clean, modern, and has the best data visualization tools. We use MetaTrader 4 or MetaTrader 5 for execution. MetaTrader looks like it was built in 1998, but it is the industry standard because it is stable, low latency, and connects directly to the interbank market. Do not analyze on your phone. Trading from a phone is for checking positions, not for making decisions. You need screen real estate to see the big picture. Day 4 through day 14 is the backtesting phase. This is where you compress time. You are not going to trade live data yet. You are going to use the bar replay feature on your charting software. You will go back in time to the beginning of last year. You will apply the strategy we built. Identifying the trend, waiting for the pullback to the 50 EMA, checking for RSI divergence, and entering on the confirmation candle. You must take 100 trades in the simulator. Not 10, 100. You need a statistically significant sample size. For every trade, record the entry, the stop loss, the take profit, and the result. Did you win? Did you lose? Did you follow the plan? If you rush this process, you are cheating yourself. You are building muscle memory. You are training your brain to recognize the pattern without hesitation. If after 100 simulated trades you do not have a positive edge, you do not pass go. You tweak the strategy and start again. Day 15 through day 29 is the forward testing phase, also known as demo trading. Now, you are trading the live market in real time but with fake money. Most people treat demo accounts like a video game. They blow up a $10,000 demo account and just hit reset. This creates a toxic psychological habit. To make demo effective, you must treat it exactly like real money. If you plan to deposit $5,000 of your own money eventually, do not open a $100,000 demo account. Open a $5,000 demo account. Make it realistic. If you lose a trade, feel the pain. If you blow the account, do not reset it. Force yourself to stare at the zero balance and understand that if this were real life, your savings would be gone. You must stay in this phase until you are profitable for 2 consecutive weeks. If you cannot make money with fake money when there is zero emotional pressure, you will certainly not make money when your rent is on the line. During this phase, you will build your most valuable asset, the trading journal. This is not a diary. It is a scientific logbook. Every single trade you take must be documented. You need a screenshot of the chart before you entered and a screenshot after you exited. You need to write down your emotional state. Were you anxious? Were you tired? Did you revenge trade? Reviewing your journal at the end of the week is where the actual learning happens. You will discover patterns in your behavior. You might realize, I lose 80% of the trades I take on Friday afternoons. Great. Now you have a new rule. No trading on Fridays. You might realize, I make the most money on pound sterling to Japanese yen during the London session. Great. Now you double down on that pair. The journal reveals your personal edge. Day 30 is Go Live Day. But we are not going all in. We are starting with the tuition fee approach. You are going to fund your account with an amount of money you are 100% comfortable losing. This might be $500. It might be $1,000. It should not be your emergency fund. When you switch to real money, something strange will happen. Your heart rate will spike. Your hands will sweat. The strategy that worked perfectly on demo will suddenly feel terrifying. This is normal. This is the psychological spread. The only way to bridge this gap is exposure. You are going to trade the smallest position size possible. A micro lot, 0.01. You are risking 10 cents per pip. You are not trying to get rich in month 1. Your goal for the first 90 days of live trading is simply break even. If you can trade for 3 months and not lose your principal, you are already in the top 10% of traders. You are surviving. You are learning to manage your emotions with real risk. As you gain confidence and your account grows, you can slowly, very slowly increase your risk. You go from risking $10 per trade to 20, then 50. This is progressive overload, just like lifting weights. If you try to bench press 400 pounds on your first day, you will crush your chest. If you try to risk $1,000 on your first trade, you will crush your spirit. Understand that this is a career, not a lottery ticket. The institutional traders you are competing against have been doing this for 20 years. They have infinite capital and supercomputers. You have your discipline, your strategy, and your risk management. That is enough to carve out a living, but only if you respect the profession. There will be days when you do everything right and still lose. That is the cost of doing business. There will be days when you want to quit. That is the barrier to entry. Every successful trader has blown an account. Every successful trader has cried over a loss. Every successful trader has stared at the ceiling at 2 a.m. wondering if they are good enough. The difference is that they did not quit. They analyzed the failure, adjusted the plan, and showed up the next day. They stopped trying to predict the market and started reacting to it. They stopped trying to get rich quick and started trying to get good slowly. You now have the complete toolkit. You know how the machine works. You know how to read the charts. You know how to manage the risk. You know how to master your mind. The path is open. The map is in your hands. The rest is entirely up to you. Welcome to the hardest way to make an easy living. Welcome to the world of Forex trading.